Dividend stock investing. It ain't easy, but someone's got to do it. I now own 46 dividend stocks. The two new positions actually come from the United Technologies RAYTHEON merger. So before I own United Tech, now it becomes three positions with RAYTHEON Technologies, Carrier, and Otis. And I continue to hold all three. So now I have 46 positions. I'll discuss that a bit in today's video. But things are a bit tough. I'll tell you why. With this nasty virus that's out there, it's created such a volatile stock market. And with the stock market plummeting, I was buying aggressively, and I was expecting to continue that trend. I was expecting to continue to buy aggressively for many weeks to come. But my buy orders, they started slowing down last week. Last week, I only made 2 buy orders. And the reason for that is this market is recovering with record speed. And it seems to me that the stock market is now decoupling from the economy. It's not really taking the economy, the economic effects of this awful virus into full account. And it makes sense why that's not happening. It's because of the stimulus that the government and the Federal Reserve are injecting into the economy, and therefore, in my opinion, is affecting stocks. I'll discuss that a bit in today's video. But basically, it's difficult being a dividend investor because now my hands are tied somewhat. I'm not ready in future weeks to buy as aggressively as I have been. And so I will be accumulating cash. I will be sitting on that cash. I will be making some buy orders, but I am going to slow the pace down. I'm going to be disciplined about it, and I'm going to save my money because I believe sometime in the next few months, there will be another buying opportunity. Now, will it be the same deep discount prices that I observed a few weeks ago when the market was plummeting? It was in free fall. Maybe, maybe not, but I'm going to be ready for it. And I surely believe at current valuations, at least for the pristine premium stocks that I love, I don't know. Maybe I'll average into them. I probably will average into them, but I'm going to go slower because the valuations are up there. And I'm going to discuss that in the video today. In fact, I'll give you a quick preview. When I last calculated my stock portfolio value, and I shared it here, my portfolio update on YouTube, I did that last July. When I compare the end of March to last July when the market was in free fall, my portfolio value was down 19%. Thankfully, cash flow was up 10%. Fast forward now to present day in April, my portfolio is pretty much recovered as compared to last July. My portfolio value is now only down 3%. And dividend income, in fact, is up 11%. I've added another 1 percentage point by buying aggressively during this downturn. And so basically, what that tells you is in this nasty time with this nasty virus, my portfolio value is worth only 3% less than last July, which was a normal time. It was just a normal time for society. And so that is very interesting. It's a very interesting data point. And so I want to discuss that in today's video. I'm going to go through my portfolio update, just a brief update there. I'm going to share the stocks with you all that I purchased last week. I'm going to share with you all an update on my ride or die stocks, my favorite dividend stocks, and where I stand with those stocks right now, given the rebound in the market. I want to discuss the power of dividend reinvestment. There's been some really, really cool reinvestment that has happened in my portfolio over the last week or so. And I have a bunch of other stuff that I'm going to share with all of you in today's dividend investing video. So let's get started. All right, so I want to start today with my portfolio summary. I wanted to share what is happening with my portfolio in this crazy market. So I'm going to share it on the screen right now with all of you. So check it out. The first table here, what it shows is the dollar value of my portfolio over time. Now, I don't reveal my aggregate portfolio value here on YouTube for personal reasons. I don't feel that it is necessary to convey the message that I'm sharing. And also just for my own privacy, it's not something that I reveal, but I have revealed and I will continue to reveal all of the stocks that I own and the percentage allocation that I have to each of those positions. And so what I want to share here are some percentages. And you see in July of last year, the starting point is just 100%. The dollar value at that time was 100%. That's just what I'm setting as the benchmark. Then just a few weeks ago, on March 20th of 2020, my portfolio value dipped by 19%. And so what was once 100% on July 2nd of 2019 was 81 cents on the dollar for March 20th. Now, fast forward to April 9th, which was this Thursday, last trading day this week of the stock market, and I'm back up to 97 cents on the dollar. It's amazing. My stock portfolio has recovered 20% from the low, and it continues to climb and climb each day. I don't know if it's sustainable. I don't know if this is just a bear market rally or not, but it is so fascinating, and I'll get to it in a minute, that it seems the stock market has completely decoupled somewhat from the economic activity that is happening out there. Now, one thing worth mentioning is I have been adding money to my stock market over all of these months, and so that has to be taken into account. I am down 3% since last July, but that does include adding more money to the portfolio. So if I had not added money, I would have been down even more. Now, that being said, my portfolio is at a high level these days. It's a large aggregate value because I've been at this so long, over 20 years. And so I am adding money, but the money I'm adding in comparison to the total, as I've mentioned in prior videos, it's kind of like steering a cruise ship. It's steering a huge cruise ship versus being on a speedboat. And so the money I'm adding, it's moving things in the right direction, but it is slow and incremental. And so these numbers do give a reasonable takeaway on what my performance has been. So I want to share cash flow now. You'll see on the second table here on the screen that, again, my cash flow, my dividends start at 100%. And even when my portfolio was down 19% at the end of March, on March 20th, my dividend income was up 10%. Now, fast forward to April 9th, and my cash flow is now up 11%. It's at $1.11 on the dollar versus last year in July. And what this tells you is just in a matter of weeks, the last few weeks, I have been buying pretty aggressively. And it's not only that I've been buying aggressively, I've been getting value. I've been buying stocks like McDonald's, Starbucks, 3M, Home Depot, Johnson & Johnson, world-class companies, and I've been getting value. I've been buying them at bargain basement prices, and they've been moving the needle. And I was able in the last few weeks to move the needle on my cash flow by 1 full percentage point. That is so exciting to see, because ultimately, why do I invest? Not for portfolio value. I share it because that's what everyone looks at. That's what everyone seems to care about. And it's probably good to care about it because it's kind of a common denominator, if you will, within the personal finance industry. Everyone looks at aggregate portfolio value. But for me, being a dividend investor, what really matters are those dividend checks, because that's what I will use to pay bills. And I already am using some of them to pay some of my bills. And so it's so exciting to see versus July of last year, I'm up 11% on cash flow. Now, obviously, going forward, some of the companies I own may cut or suspend their dividend temporarily, or even maybe not so temporarily. We will see. But thankfully, so far, out of all my 46 positions, I've not had any government bailout companies, because we know if these companies take government money, they will temporarily not be able to pay dividends until the government bailout money is repaid. But I don't own those stocks, and knock on wood, hopefully that will continue, that I won't have any companies that need government bailout assistance. And so far, out of my 46 positions, none have cut nor suspended the dividend. And we'll see. Maybe, look, I'm expecting at least one or two to cut or suspend the dividend. But so far, I have been lucky, and I think it illustrates the power of going with premium quality, top quality dividend stocks versus kind of riskier, high yield or yield trap type of stocks. I've always been about quality. It's served me well. And what this downturn, this virus has taught me is I want to double down on quality. Out of my 46 stocks, there's about 11 of them, my ride or die stocks, that are of the best quality. And I'm actually just focused on those stocks now because I want to take the quality to the next level. I want to take it even further than I have in the past. And so I started thinking, what is going on here? We have this virus. It's shut down worldwide economies. And yeah, some of my companies, they'll do just fine throughout all of this because they're selling food and beverages that we eat at home, for example, like Coca-Cola and Pepsi, or they sell medications and medical devices like Johnson & Johnson that we all need. But some of my other ones, look, companies like Starbucks, they will be facing some softness this year because fewer people can go to Starbucks when we're all stuck at home. And even if we could go to Starbucks, you're kind of just stuck waiting in a drive-through. The locations where you have to like go inside, very few of them, or at least based on my local market study, are open right now. And so certain companies like Starbucks, I'm buying. And look, it's one of my favorite stocks of all time. But I'm not going to kid myself. This economy is going to crush the results of Starbucks this year. Now, going into future years, I think the results will be fabulous. But the economy right now is soft for many companies, including ones that I own. And it's interesting. Why is the stock market rallying so much despite this economic uncertainty? And at this point, not only uncertainty, this economic weakness that many companies are going to face this year. Again, there's outliers like Johnson & Johnson and stocks like that, PepsiCo, but many companies right now are, including the ones I own, are facing weakness. And so you start looking at what the government is doing. You start looking at what the Federal Reserve is doing. And I've discussed this in some of my prior videos, so I don't want to spend too much time. But basically, the government has passed a $2 trillion stimulus package. This is President Trump's stimulus package that he passed. Now, mind you, what's so interesting about this is I was sitting in on a call last week, an economics call where really sophisticated economists were talking about the economy and the stimulus and what they think it means. And one of my takeaways from that was that the belief, at least of the presenter that I was listening to, is, hey, that $2 trillion, it'll get us through about 1 month. And so it's likely that President Trump is going to have to push forth more stimulus packages on the order of about $2 trillion per month for as many months as the country is shut down. And so you start thinking about that. Now, on top of that, as I mentioned in my last video, also the Federal Reserve lowered interest rates in an emergency meeting down to 0%, a range of 0 to 0.25%. The Federal Reserve also announced $4 trillion of initiatives to revive the economy. And just this last Thursday, they announced another $2.3 trillion on top of that. And so these days, it is difficult for me to keep track of everything that's going on with the government and the Federal Reserve because it's almost like every day there's something new. Now, I think this is good. They recognize that there's going to be weakness here, that there already is weakness. They're trying to pass these packages, get them into action fast, because we know the quicker we can do it, the quicker the economy will basically revive once we all get back to work. And even now, while we're at home, certain companies are able to certainly benefit from these packages. And so I generally feel that the government is doing a good thing. They're being proactive. But I also start thinking, hey, there's about $8 trillion of stimulus so far, and it will probably only get more. And that's a lot of money. And so then I start thinking, if $8 trillion of stimulus just kind of pops out of all of this, comes out of nowhere, I start thinking, hey, do I want to be owning dollars or currency, or do I want to be owning dividend stocks? Best of breed, world-class, international, globally recognized companies that have pricing control, that can raise prices if there is an inflationary environment. And what I also understand to be happening now is even the Federal Reserve is out there looking at ways to basically prop the financial markets up. And so what I believe is happening right now is there's a decoupling. There's a decoupling between the economy and the stock market. The stock market is now trading at levels where it's looking probably a few years out. It's not looking at the economy this year. It's looking past that. It's looking past the results from this year. It's looking forward to 2021, 2022. It's really looking forward right now. And so I don't think that's a bad thing, but it's kind of what makes dividend investing difficult, because the stock market is not a reflection of the economy now. It's a reflection of the economy in the future. And it's looking really far out right now. And what's difficult for dividend investors, myself especially right now, is waiting it out. It's time for me to be patient. It's time for me to wait. It's time for me to let some cash accumulate in my account. It's time for me just to wait for buying opportunities, because I will illustrate to you in just a second the stocks I've been buying in the last few weeks, and you'll see that the PE ratios, they are not that good. And so stocks, in my opinion, right now, even, maybe second-rate stocks or riskier stocks, high yielders, yield traps, energy sector stuff. And look, I own it. I love it. I respect it. I love everyone in the energy industry. But those are risky, and those are still on sale. And so some bargain shoppers, they're going to get some value there. But I'm talking about premium, ride or die, top-notch quality companies right now. They are richly valued, if not overvalued. And so for me, that makes it difficult, because we're in this situation where the economy, it's really shaky. It's a shaky economy. It should be a time where we have weeks to make stock purchases. But what I learned so far is literally there were days. There was only a few days, and I'm glad I bought stocks, but I wish I went even more aggressive, because I surely thought the buying opportunity would be here a bit longer. And look, I'll pile up some cash, and I'm sure there will be another one around the corner. But it's just so interesting to see the decoupling between the economy and the financial markets. Hopefully, quite frankly, the financial markets know something I don't. Maybe they've rebounded because they know we're all going to get back to work sooner than I even think. And maybe the downside from this virus isn't so bad. And so I'm praying for everyone's health out there worldwide, and in our community, the dividend community, that we get through this thing really quickly. And so that's agenda item 1. Just wanted to do a portfolio value update to just show you the roller coaster I've been facing so far, but also the stability, despite the roller coaster, the stability that dividends have provided, because the cash flow has been up and to the right. Okay, so let's do it. Let's move into agenda item 2. I want to talk about the stocks that I purchased last week. So I'll share that on the screen right now. All right. And so last week, there were only 2 buy orders. On Monday, I purchased Starbucks, and I purchased it for $66.94, starting yield of 2.45%. Check this out. The EPS estimate is now $2.03. This is down from $2.51 just a week ago. So analysts week over week have lowered earnings guidance on Starbucks by basically 50 cents. And so, mind you, the $2.51 from a week ago was down from weeks prior as well. So they keep lowering and lowering and lowering. And if they keep it up at this rate, there's going to be no earnings left. So hopefully they're kind of getting to a realistic number here, and it's not too much worse than the $2.03 that are estimated for 2020. But check this out. Because the EPS has been revised lower, my PE, 2020 forward PE on this purchase price is a 33 basically. It's 32.98. So this thing's getting expensive. And the payout ratio on the dividend now is 81%. And so that's getting up there. And so the key takeaway I had from this Starbucks purchase is, look, there would be nothing I want more than to double or triple my Starbucks. Look, heck, I'll do 10 times. I'll 10 times my Starbucks position. I would love to. It would be amazing. Make it my biggest holding. I'd love to do that. But I have a fiduciary responsibility to myself here not to go too crazy. And when I see things like a 2020 PE of 33, I don't know how many more tranches I'm going to be buying here. Maybe I'll dip in and buy a few more, but these are small tranches here because I'm nimble. I'm not buying my huge tranches anymore because I'm doing more purchases, being nimble. Now I'm going to scale back the purchases, but I'm also going to keep the tranches small, conserve cash for when the market does get a little bit cheaper. But this is just expensive here. And check this out. On Thursday of last week, I purchased some more 3M. I bought some 3M at $146.73. My yield on that purchase price is 4%. And so, in my opinion, buying 3M at a yield of 4% or more is winning. That is winning. That is just so amazing. But look, the PE is up. It's up at a 17 now. It's up at a 17 because the stock price has recovered, but also because the EPS guidance is lower. And so they're expected to earn less money this year. It's at 853 now, and that's down from 878 just last week. And so the decline is not as drastic as Starbucks on the earnings guide or the earnings expectations from analysts, but it's down and it's trending down. Now, still at a PE of 17, starting yield of 4%, out of all the stocks I own, all the companies I own, 3M is probably the one I feel best about, or one of the ones I feel best about buying here. It's still a reasonable value. And what I like about them as well, everyone was giving them so much trouble just a week ago because President Trump in his press conference was mentioning he was unhappy with 3M. In my last video, I said, look, everyone, this is kind of like Gillette from a few years ago when everyone got all worried about Gillette, Procter & Gamble, people saying I'm never going to buy those razor blades again because Gillette, I don't like their advertising campaign, this and that. No one remembers that now. And quite frankly, if anything, I'm a marketer by trade, and there's a saying in marketing, and I don't know if I believe it or not, but a lot of the time I do, is that kind of all marketing is good marketing, even if it's not the best of PR. And you kind of see that with Procter & Gamble. They've done just amazing. And with 3M, they got past that criticism. In fact, my understanding now is they're on good terms with President Trump. They took his critique, his criticism, his tough love, if you will, implemented it to make their operations even better than they already were, while also U.S. operations, while also serving global humanitarian needs. So I feel like 3M is balancing worldwide demand for their products really well. And my understanding now is President Trump is not unhappy with them anymore. And on that news, the stock has been rallying. And so that's one of the reasons as well that it's going up. In addition, just to being a good value in the overall broader market, kind of, especially quality companies rebounding, as I mentioned, I think the fact that temporary worry with President Trump, it's just kind of out of the way now. And this is what I was mentioning just literally in my last video. I don't, certain things I worry about, certain things I don't. I knew when President Trump was critiquing 3M that they would quickly get past that, as they have. But here you have it. I only bought 2 stocks last week. It was a boring week. I'd like to buy stocks every day, but I also, as I mentioned, have a fiduciary responsibility to myself. And I'm only buying ride or die stocks now, and they're all quite expensive. And so I'm just going a little bit slower right now. And you'll see here on the screen that the average PE on forward 2020 earnings of these stocks that I just bought, 25. That's really high. And what I'm going to do, actually, I'm going to share on the screen now the last few weeks as well, so you can see what I did the prior weeks. And what you see is last week, my average PE was a 24. Week before, 20. Week before that, 19.86. Mind you, all of these PEs have been updated to reflect the most recent data, but you can see just through that PE analysis that the stocks have been getting more and more expensive. And what's interesting is McDonald's is another one. I bought McDonald's last week at $157.86. At the time, the PE looked better than it does now. Now the PE for 2020 forward is a 24.25. Why is that? Just since last week, analysts have reduced their 2020 estimates from 755 down to 651. And so earnings estimates are going down, especially for certain companies like McDonald's and Starbucks. And I'll give you a takeaway, a side note here. I'm not only looking at PE now because, look, companies like Starbucks and McDonald's, they will spring back. Of course, 2020 earnings look awful. Of course, PEs are inflated. They're going to snap back. They're going to bounce back once we get out of this nasty virus. And so I keep that in mind. And quite frankly, that's probably why I will continue to average into a bit of Starbucks and McDonald's, because both of them are still pretty heavily off of their highs, much more so than my other ride or die stocks. So I'll continue to probably average into them. That said, I got to slow down and be cautious. That's the hard part of it all. And so these are my buy orders the last few weeks. It's just so interesting to see that already things are getting back to full, if not richly valued levels in these particular stocks. So I want to move on here to the next topic. And the next topic is going to be my ride or die stocks. I want to give a quick update, just broadly speaking, of all the stocks I track. What are they looking like? And so I'm going to bring that up on the screen right now. And what you'll see here is, again, a story of things getting more expensive. So something like Johnson & Johnson now, it's now yielding 2.69%. That starting yield is not that exciting anymore. It's certainly not as exciting as it was when it was over 3. And the PE is up at 17. Hey, out of everything on, it's only down 8.6%. This is really fundamentally important for people to understand. There's a lot of stocks on sale right now. I'll give you an example. Cedar Fair, I own it. It's a risky company in this market. I don't know if they're going to be able to pay out their full distribution this year. That's one where I would expect a distribution to get potentially suspended, at least temporarily. I think it'd be a wise thing for them. We'll see if they do it or not. But that's an example right there of a company that is trading still at well off its highs. But when you look at premium companies, companies that weather the storm, type of companies that I really want to have, say, 75% or more of my money in, they're not down that much. Now, mind you, on my most recent portfolio update, I looked at my ride or die. What percentage of my aggregate portfolio do they make up now? They make up 49% of my holdings in terms of dollar value, and they make up 38% of my cash flow. I would like to see the dollar value up, I would say, at about 75% or more. That's the goal. And so that's why I'm focused all day, every day on these stocks. But J&J, it's only down 8.6% from the high, from the all-time high. That's not much. And PepsiCo, similar thing. It's only down 9% from the all-time high. The starting yield is a 2.86. The PE, it's a 23. You start thinking, why is this? I'll tell you why. The reason this is what it is because already $8 trillion worth of economic stimulus is entering the United States economy. That doesn't even look at the global economy. It's this unprecedented amount of basically printing money and taking on debt and providing stimulus that gets people thinking, hey, maybe PepsiCo at a PE of 23 isn't a bad place to park my money, given where just currency may or may not be in the future. I think that might be why the stocks are trading at such lofty valuations. But I'll tell you, I'm reinvesting dividends, but I'm not buying net new shares of Pepsi here with net new capital. It's just too expensive for me. McDonald's 2020 PE is a 28. Now, I'll tell you with McDonald's, though, it is off 17% off the high, which is still a reasonable correction for this company. So I probably will buy another tranche, but I'm not getting a value. I'm not going to fool myself. I'm getting no value here. Certainly not like it was very momentarily. Clorox, it's already been expensive because they make the wipes, and the wipes are important for the situation we're in. And so 28 PE. I'd say Duke is still a reasonable value at a PE of 17 and a starting yield of 4%, but it's off only 13% from the high. It's a utility company. It's kind of trading where it should be trading. Procter & Gamble, Coca-Cola, they're not values at all. Although Coca-Cola is off 18% from the high, so maybe you could say, I don't know, I'd just say probably is overvalued before. But it's facing probably a little bit of pressure there because of the Costa Coffee franchise, and they have a bunch of coffee locations in the UK that they cannot open. But honestly, in the scheme of things with Coca-Cola, it's a smaller part of their business. But I love Costa Coffee. What an amazing, amazing place. 3M, I got to say that out of all of them, this is the best, in my opinion, value now. And this is the one I will be buying next week. I will be doing it. I'll average in at least once, maybe twice. We'll see. Have a long way to go. Would love to double or triple the size of my position in 3M. And the starting yield, it's just under 4%. PE is a 17, and it's down 32% from the high. And I know the PE is, being an industrial company, it's like a spring. It's kind of like these restaurants. It will spring back, and it will spring back to the upside. And so the PE for 2020, it's a little misleading. And so I still look at this one as being in bargain territory, certainly under $150 a share. I really like my 3M. Kimberly-Clark, it's an okay value, PE of 18, yield of 3%, 3.26, but it's off only 12% from the high. Starbucks, it's still off 25, 26% from the high, but that 2020 PE now is at a 36. It's getting really richly valued. Even looking to 2021, 2022, that PE is going to be pretty high. It's going to be those mid-20s, in my opinion, based on where it's trading now. But it is such a premium, amazing company. I've got a thing for Starbucks. I'm probably going to buy even at these levels, but the data would probably tell me otherwise. And that's why it's hard, honestly, being a dividend investor, too. I would say sometimes it's not all about the data. There is that emotional side to it. At least I'm being emotional with a world-class company that is trading a good 26% off all-time highs. Okay, Home Depot, still a yield just under 3%, so reasonable starting point on a yield basis. PE at a 20, I'd say fully valued, if not richly valued. Off 19% from the high, so maybe there's something there. Realty Income, this is why dividend investing is difficult. In my last video, I mentioned I wanted to go ahead and buy some Realty Income this last week. I decided not to buy Realty Income this last week because it was surging in price so quickly, and so it kind of got away from me, but I had the discipline there to just wait at this point. That said, at a starting yield of almost 5%, and it's still off 33% from the high, not a bad entry point for Realty Income, but like I said, this is why it's getting a little difficult here, because this decoupling of the market and the economy and just the sheer amount of trading days where the deep discount values were there, it's very few. And it's a lesson to me. It's a lesson to the community that, quite frankly, it's about striking while the iron is hot. There was very few days to strike. I'm glad that I did when I did. But in retrospectively looking back and doing a post-mortem on the exercise, what I learned is save up a big war chest of cash. And when those good days are there, just go heavy. Go heavier than I did. But you live and you learn. And that's what I love about investing. 20 plus years into this, I am still learning every single day. And I got to stay humble and keep learning. So check this out. The average PE on these, not including Realty Income, because that's not on a PE basis. It's valued on a price per adjusted funds from operations. So I kind of carved that out. But the ones above, PE trading at a 23 on forward earnings, fully valued, if not overvalued. And so state of where we are right now. Now, I want to mention, while I'm on this screen, just talking about ride or die, people were asking, Ian, why is United Technologies not on there? Well, now it's not United Tech anymore. Now it's RAYTHEON Technologies, Carrier, and Otis. That's my number 4 favorite stock of all time. I kind of look at them as one now. I'm going to hold all three. And people wondering, what am I going to do with these companies? I don't like owning 46 companies. It's a lot of companies. But at the same time, I don't want to sell. The way I am basically prioritizing my net new capital these days is I'm only deploying it on the ride or die stocks. And eventually, my top, say, 11 stocks will comprise a good 75% of the portfolio. I'll feel good when that happens. That's how I plan to stay away from diversification. That being said, I own a lot of stocks, and to kind of contrast what I just said, I just don't sell. I'm not doing it. And so United Technologies, is it a ride or die stock for me? No. Is it still a stock I really love? It used to be my number 4 favorite stock of all time. It's still highly regarded. It's still, I'd say, a top 15, top 20 stock holding for me. What am I doing? I'm going to hold all 3 positions that came out of it, and I will wait and see how things go. I would expect for all 3 to pay dividends, and I would expect for all 3 companies to do very well. I especially like RAYTHEON Technologies, which is the aerospace and defense. There's pros and cons with the RAYTHEON merger. One of the pros is that it gives me more exposure to the defense industry, which I don't have exposure to historically. And so it's nice now to have that exposure. I would say the cons, would I seek out and go buy it if it weren't for this merger? Probably not. And so there's kind of philosophical reasons there. It's just not an industry that I get that excited about because, quite frankly, you don't have a lot of customers. You got one customer, the U.S. government, pretty much. And that customer can change quite a bit depending on administration. Is it a Republican president? Is it a Democrat president? What are their policies as it pertains to defense? That kind of stuff. Also, I just kind of think philosophically about what they do. Does it align and jive with what I want to invest in? I don't know. But at this point, like I said, I don't sell, and so I'm in it. I got exposure to defense. I love the jet engines that United Tech has always produced through that division of their company, and so I've got that exposure now to defense. Now I'll tell you, Otis I also really like because it's an elevator company. And in the elevator space, there's a few big guys. The big ones are Otis. There's another one called ThyssenKrupp. And I think there's like one other. But the big guys, they basically have a monopoly. And what happens is if there's any kind of competitor in the market, they just acquire them. And what's great about companies like Otis is they lock those people with Otis elevators into long-term service agreements because you need your elevator serviced. And you need it serviced per code, per ordinances. And so basically they've got recurring revenue and it's not going anywhere. And so I love Otis. Of the 3, maybe my least favorite is Carrier. They make HVAC equipment under the Carrier brand, under the Bryant brand. I've always had a good experience with their equipment, and I don't know, I never really would set out to buy a standalone HVAC company. So of the 3, if I had to sell one, it'd probably be Carrier. But again, at this point, I haven't even looked at the books. I haven't even looked at the financials. I look forward to seeing the first quarterly reports of each of these new companies. I'll be able to use that data to get a better handle on the fundamentals and see how things pan out on a go-forward basis. But I'll tell you, when I shared my stock portfolio update at the beginning of this video, what I assumed, at least off the bat, my dollar amount of dividend income that I would receive from the 3 companies should be more or less similar to what I was just receiving from the single United Technologies company before. And I do expect certainly all 3 companies to pay a dividend and to probably increase the dividends over time, but time will tell. I'm not selling. And would I have preferred it all just to stay one company? Probably, but now that it is 3 companies, I'm going to hold all 3, manage all 3 as one company, but I'm not adding net new money to it anymore. I am reinvesting dividends for all 3 of those positions, but I'm not adding net new capital. Net new capital I have is going to ride or die. United Tech doesn't make my ride or die anymore. It would have otherwise, maybe if it stayed a standalone company, but now that it's the 3, I don't really want a defense aerospace company in there. I don't want an elevator company or HVAC company in ride or die. If it were one company, maybe I'd have it in there, but I don't want to add those 3 in there. Certainly, it just isn't aligned with where I want to be going. And so I'd be curious, share in the comments below what you think of what's gone on with the merger with Raytheon and then the decoupling from Otis and Carrier. I'd love to know if you're holding, you're selling, you're holding some, selling some. Share in the comments below. We have a thriving community. I love all of you. So I want to skip now to the last topic for today. Actually, I have some bonus stuff to talk about at the end, but I want to share the power of dividend reinvestment. And so I'm going to pop some statistics on the screen right now. Last week, I shared how I reinvested a PPL Corporation dividend and how I got it at a really good price and why dividend reinvestment, it's really powerful in a volatile market, because in a volatile market, sometimes it comes with a volatile economy. And unfortunately, a lot of people right now are facing financial hardship. I pray for everyone, not only from a health and safety perspective, but from a financial perspective, because a lot of people right now are facing job loss. They're facing loss of income. And from an investment standpoint, oftentimes what people do during these tumultuous times is they don't want to buy aggressively. They want to be careful with capital. And everyone here needs to assess their own situation. I'm just sharing my personal journey. I'm in a position where I feel comfortable deploying net new capital, but I am only speaking to my own position. There are others here that may not want to deploy net new capital. They may be thinking about just saving up capital for the uncertain. The benefit of dividend investing is it gives us options. It gives us the options to reinvest dividends and deploy new capital, to not deploy capital, save it up, but still reinvest dividends. And it gives us options, quite frankly, to take out the dividends and use the dividends for bills. And even if the dividends don't cover all of your bills, they certainly can help towards some of the bills during uncertain times. So that's why I love dividends so much, because it's all about the cash flow. Portfolio value is nice, feeds the ego, but it's not why I do it. I do it for the cash flow. But anyways, even with me during times like this, I was just saying, I wish I deployed more money on those down days. I was aggressive, but boy, if I had known those down days would be so few and far between, I would have gone even more aggressive. But what's nice is I started looking at my dividend reinvestment, and that's what you can see on the screen right now. And I got some great buy orders, some great purchase prices went through. So let's check it out. Home Depot on March 30th, I reinvested dividends at a price per share of $189.38. It's already up 6% from then. So I got my shares lower than they're trading now, because it reinvested on March 30th when share prices were lower. I got a starting yield of 3.2% and a PE of 18.86. So that's a great buy order. Maybe I wouldn't have, I wasn't buying Home Depot that day. And so my dividends, I didn't even know it was doing this till I looked at it literally tonight before I started filming this video. By the way, it is really, really late at night now. It's Saturday night, Easter Sunday tomorrow. Hope everyone has an amazing Easter holiday. But I know tomorrow is family stuff, obviously all at home because we're at shelter in place, but we have a fun Easter egg hunt planned for our kids in the backyard. My wife was saying she just filled up 100 eggs, over 100 eggs, she was saying. And so it's going to be an epic Easter egg hunt tomorrow, but we have the church that we attend has a virtual online church for tomorrow, and it's just going to be a big day of family stuff at home. And so, anyways, it's I don't even know what. Oh, there it is. It's wow. It's almost midnight. It's 11:50 right now. But you know how we do it. Thug Life Investing. This is why it's Thug Life Investing right here. Basically, in a nutshell. That's what it's all about. Late night in the garage studio. So anyways, I was just looking at these stocks. these reinvestments tonight when I was preparing for this video. I didn't even know I was buying Home Depot at these prices. And this is why I love dividend investing, because it's automated. It's not only optimizing my buy prices, but the reinvestment, it's automated. It saves me the hassle of logging in and doing something. It happens for me. Let's look at the next one. The next one was PepsiCo on April 2nd. I got it for $124.02. It's already at $133. It's already up 8% from where I bought it, from where I reinvested the dividend. Automatically, mind you. I didn't know this was even happening until I looked today. I got in at a 3.1% yield. Awesome. PE, 21. Hey, at least it's better than the 23 that it's at right now. Next one was Coca-Cola. I got some at $43 on April 3rd. This was, again, my dividend reinvesting automatically without me even knowing. It's already at 49. It's already up 14%. Oh my gosh, I'm happy to get some Coca-Cola at those prices at a 3.8% starting yield. That's a really high starting yield for Coca-Cola, so I highlighted it. I really like it. PE is not great. It's a 21, but hey, I'll take it. I'll take it. Kimberly-Clark was the last one that I noticed on April 6th. I got it at 126 and change. It's already at 131 and change. It's already up 4% from where my dividend reinvested. And I got a 3.4% starting yield, 17 PE. I love reinvesting dividends because I don't even have to think about it. I don't have to think about it. It does its thing. It optimizes my buy price. And so this is, quite frankly, let's say I had no net new capital to invest right now. Just seeing the dividends reinvest alone is so gratifying. It is so amazing. It is so, it's just one of the miracles, I would say, of dividend investing. I love it so much. But that's that. That's what I wanted to share in the video today. Before I go, I want to do something really cool. I want to share a few things because, look, it's almost midnight. I'm going to look at my notes here. I jotted down a few things I want to go through. So first, quick tip. I don't know if all of you at home, sometimes you wonder, Ian, how do you do what you do? How do you have the energy on these videos late night? One of my tidbits I shared in my last video, how I have an appreciation for rap, hip hop music, and how I love it because it's so inspiring across, it teaches me so much. Quite frankly, the artists, they are very smart, and they have lived through things and seen things that give them experience in life and business. And I'll tell you, it's kind of like right now. We're in a really volatile stock market because things are tumultuous. I'm learning more than ever before. Well, think about the hip hop artists because of how they grew up, because of what they went through, the struggles. It's kind of like their lives were and probably continue to be in many respects very volatile, but volatile times produce wisdom. And so anyways, there's a lot of wisdom that I derive from hip hop, and I shared some of it in my last video, but I want to share a tidbit with you today. When I'm preparing for my YouTube videos, the thing I always do before I flip on the camera is I listen to at least one hip hop track. And the one I was listening to tonight was by an artist named Roddy Ricch, and he has a track called Rich Forever. Not safe for work. Watch it on your own time. But it's a great track, and I mostly listen to hip hop artists from the past, from the 90s and early 2000s. But once in a while, there's a new artist that pops up that I like, and Roddy Ricch, he is one of them. He's got some great music, and I really like the Rich Forever track. Now, it's a sad track in the sense that he's talking about his homie passing away, but it's optimistic in the sense that he's also speaking of being rich forever. And quite frankly, that's how I look at dividend investing. Dividend investing is something that can be passed on to future generations. And I know a lot of people watching may not have kids or may not plan to have kids, but the dividends can still make you rich forever because they can be passed on to a charitable foundation, for example, and your dividends can do good forever. And so that's why I really like that track, Rich Forever, and it gets me thinking about dividends, gets me hyped up, gives me some energy. Tonight I was so tired, I was thinking, should I be drinking coffee? Can't do it because then I'd probably be up all night. But anyways, that's that. That's how I get hyped up for my videos. And on the topic of doing good, and quite frankly, people passing, I want to share a story. So I shared in my last video, my homie Bernie, my brother from another mother. He is running a program right now where he is providing meals for nurses in the greater Florida, Miami, Dade County area. And his wife is a nurse, and he's been bringing food to the nurses at her hospital to feed them breakfast, lunch, and refreshments, because these nurses are working really long hours, and they're triaging this horrible virus out in a tent outside. And the tent in some instances is even as high as 100, 110 degrees inside the tent. So needless to say, these heroes are working really hard. And what I want to share is, God bless all of you out there. We as a community, well, I should say Bernie, his GoFundMe has now raised $2,725. And believe me, that money is already doing so much good. He's posting updates on his GoFundMe now almost every day. I'll share some photos as I'm speaking right now from the very lunch that was provided. One of the lunches, I should say, that was provided from our community so far. But basically, of this $2,700, a big percentage of it was raised from our community. Because literally in my last video, I said, hey guys, check out Bernie's GoFundMe. Pitch in if you can. And I mentioned even small contributions as low as $1, $5. Every single dollar makes a difference. And you all rose to the occasion, and I just want to say thank you from the bottom of my heart. God bless all of you. Thank you, thank you, thank you. Bernie and I have had such a fun time this last week because it's been a rush. It's honestly been a rush seeing the money come in. It's been more rewarding than seeing dividends come in. It's been more rewarding than seeing the portfolio value grow, all that kind of stuff, because this money is making such a difference out there. And it's making a difference in a few ways. We're providing lunch and breakfast for these nurses. And I'll tell you what's happened is there's other people have caught on. And so now there are restaurants, in addition to what Bernie is doing, just coming independently to bring food to the hospital. And what this allows, so basically the goodness, it's going viral. This is what we wanted. What's so exciting, though, is now Bernie can also use the funds not only at his wife's hospital, but at some of the other nearby hospitals that are less fortunate, some of the ones that don't have as much money, some of the ones that are in poor areas. And so it is a blessing to know that these efforts in Florida and Miami and Dade County are having a ripple effect. And what Bernie was saying is he's also now been able to negotiate really good prices with the restaurants that he is sourcing from. He's gotten them to vary up the menus a bit. And so he's helping small businesses that are hurting so much right now, in addition to giving hope to the nurses, giving refreshment, nourishment to the nurses, giving nurses the fuel that they need to get through the day, to do God's work, to save lives, to help people who are coming in with this awful virus. And so it's so exciting to see the nurses benefit and have great morale, but also the small businesses. But also what Bernie has been able to do is find some drivers to drive the food as well. And so it's really amazing to see this campaign growing. And more than anything, Bernie, if you're watching, I just want to give you a shout out and let you know that it is an honor for me, for the ppcian community, to be involved in this. We are blessed to be working with you. And I'll tell you, I've always had amazing respect for you as a friend. But what I would say is, out of this experience, Bernie, I'm impressed with you as a business person. You are a true OG thug life business person, because the way you're running the program here. You're negotiating with the restaurants. You're working with the drivers. You're putting it all together. You're being scrappy. You're keeping good records. Check it out. On my Instagram, I share photos and summaries of some of the things that are happening, but also just check out the GoFundMe where Bernie posts all the time. Man, the level of meticulous note keeping and bookkeeping is amazing as well. And so anyways, long story short, but I wanted to take an opportunity to thank you all. But also, I hate to close on a sad note, but it goes back to Rich Forever. I was kind of listening to that song, and it reminded me that Bernie mentioned the nurse who was one of the apparently the lead nurse, the head nurse of the department at his wife's hospital. She, bless her heart, unfortunately passed away from this awful virus. And so as Roddy Rich was speaking of his homie that passed, all of these nurses lost their friend, lost their colleague who was their leader. And she left behind family, a husband and a child. And so it's sad. It's sad. And so, in fact, we should take a moment of silence right now for that brave hero who lost her life saving everyone else. And so I just want to say thank you again to everyone who contributed. Your money is making a difference. These nurses are working their hearts out. There is some fear out there because they're seeing, they saw one of their colleagues lose her life. And so the money is bringing the food. It is bringing morale. We are praying for the greater Miami-Dade County area. And now that Bernie's going to go to some of the hospitals, in addition to his wife's hospitals, some of the ones in the poor areas, let's just wish him well. If you can continue to contribute or you haven't yet, check it out. I'll do it in the pinned comment below. I'll link to the campaign, the GoFundMe campaign. But also I'll tell you, I feel your prayers coming through as well. And so prayers are very welcome as well. And I'm just telling you, seeing what's happening out there with the campaign, with the donations, I just have a sense that everyone here in this community is praying for it. And thank you for that. It's looking back on this crazy time, I want to surely be have a story to tell on what's going on the investing side in the financial bank account. But on the spiritual bank account, I want to have a very fond story to tell the kids, the grandkids in the future. And so it's a blessing to be part of what Bernie's doing. And so again, shout out to all of you and shout out to my homie, Bernie. Thank you for letting our community be part of what you're doing.
Thank you, Meals for Heroes.
Okay. And so the last thing, actually, let's close on a positive note. I officially launched today new merch. And so I've been kind of hinting at it for a while now, but I did a blog post. I'll link to it in the pinned comment below if you want to check out the new merch. I got 4 new styles. 2 of the styles actually were inspired by members of this community on my Facebook group. I ran a little request. I said, come up with a slogan. If I like the slogan, if I use it in the shirt, I'll give you a free shirt. And so 2 of the shirts were inspired by slogans from all of you. And so thank you to members of the community. I love the merch, honestly, from a selfish perspective. I just enjoy wearing it. So check it out if you haven't already. I know a lot of you already seen it, but I did a blog post. And the benefit of the blog post is I have pictures of myself wearing the merch, and you can click them and see them in very high resolution to just get an understanding of how the merch fits. And also, in terms of just taking care of the merch, I have some suggestions in the blog post as well, because 2 of the items are more on the delicate side. And so hand washing or gentle cycle washing and hang drying is recommended, especially for those pieces. But anyways, check out the blog post. All right, everyone, it's late. Okay, now we're after midnight, so I got to wrap it up. I love you all. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my personal journey here on YouTube for fun and entertainment. Investing in the stock market and anywhere else carries tremendous risk, especially in volatile times. And so please remember that I'm just sharing my journey here for fun. Also, in terms of a full disclosure, I own the stocks mentioned today. I am long the stocks mentioned today, which include, let me pull it up here real quick. Johnson & Johnson, ticker symbol J&J. PepsiCo, ticker symbol PEP. McDonald's, ticker symbol MCD. Clorox, ticker symbol CLX. Duke Energy, ticker symbol DUK. Procter & Gamble, ticker symbol PG. Coca-Cola, ticker symbol KO. 3M, ticker symbol MMM. Kimberly-Clark, ticker symbol KMB. Starbucks, ticker symbol SBUX. Home Depot, ticker symbol HD. Cedar Fair, ticker symbol FUN. PPL Corporation, ticker symbol PPL. Realty Income, ticker symbol O. RAYTHEON Technologies, ticker symbol, I think it's RTN or something like that. Otis, ticker symbol OTIS. Carrier, ticker symbol CARR. And I believe that's it. Those stocks, I own them all in my personal dividend stock portfolio. Everyone, I'd be curious, how's the quarantine, the shelter in place going for all of you? Fun fact, my wife cut my hair today. I think it turned out really well. It was a little stressful, I'll tell you, because it's the first time I've had my hair cut at home. And so just wanted to thank my amazing wife for doing such a good job. I just feel better. I feel like it was getting kind of messy. And so nice, so fresh, so clean these days. Share your quarantine, your shelter in place stories in the comments below. Would love to hear how you all are making it through this. We're going to bounce back. We're all going to be back to regular life, hopefully sooner than later. That's what I'm praying for. Got to break out of all of this sooner or later, get back to normal life. Please like, subscribe, comment. All of that means the world to me. Greatest way you can thank me for these videos. All right, everyone. I will see you in the next one. Have a blessed, amazing, fun Easter holiday if you celebrate. If you don't, have an amazing Sunday. Love you all. I'll see you in the next video.